Good morning, everybody. Just want to tell you we're going to change the show up today. We're just going to go to a live link of Rachel Reeves for the whole flow show, and I'm going to go out down the cafe and get some breakfast. So, going to switch you over in a moment, and you can have a pleasure for the next hour or so. Just kidding, of course. Morning, K-Man. Are you here, or are you plugged into the Bird from Accounts?
No, unfortunately. And good morning, Ryan. Good morning, everybody. I couldn't plug into Reeves because I had the bins to take in this morning. So, I had something really far more important to do. Sorry.
Yeah. You better do them now before they get taxed, like everything else at the moment. But yes. So anyway, Rachel Reeves is waffling on. If you're in our chat room, you can get the super nuts of what she's banging on about anyway, because the speech was largely out yesterday. Anyway, I think that's potentially why we're seeing a little bit of a bid in the quid the last couple of days, just because they've been on a bit of a growth push or growth offensive for the last few days, but we'll get to that shortly if I can be bothered. Right, straight over into Japan because there's now happening in China right now because they're all on their hollybops. A bit of news missed yesterday. PM Ishiba has nominated Junko Koida as the replacement at the BOJ. Adachi is leaving and term ends in March. And so the new girl is being nominated to go into the BOJ. Apparently, she's a bit on the hawkish side, as much as you can be, being in Japan. Apparently, a proponent of not necessarily waiting for the economic numbers before moving on policy. So that's something we'll have to deal with later on. Not expected to vastly change the landscape at the Bank of Japan, but potential hawk going in to that one. Mr. Ishiba is also trying to play nicely with Mr. Trump. Apparently, he's going to look at taking some shale gas imports from the US to show that he's ready to do some deals with Trump. Japan, touch wood, could be one of the countries, maybe like the UK, that actually swerves having the tariff stick waved at it. As we know, Trump had a great relationship with Abe back in his first term. He gets on with Japan a lot, so likely that's one country that plenty of deals are going to get done pretty quickly, and they won't get harmed too much, but we'll wait and see for that. RBNZ's Chief Economist Conway says without future shocks, the OCR official cash rate will tend towards the neutral interest rate. It says the long-term nominal neutral interest rate currently lies between 2.5 and 3.5%. That's with their current rate at 4.25%. So still quite some room for cuts from the RBNZ. Over in Australia, we had the CPI data out overnight, and good news for the RBA in wanted inflation down. Pretty much all the measures came in lower and lower than expected as well. Quarterly year-on-year CPI 2.4, bit below expectations for down last month. Their trimmed mean doing similar, coming in below expectations, good chunk down. Their weighted quarterly mean, a bit like a core type number, also coming down. The December number, though, that went up as expected to 2.5%, but the market has largely ignored that. Some banks putting forward their rate expectations, Westpac being one of them. They now see a cut coming in February. They last projected that they would cut in May. Some of the others also bringing their rate cuts similarly from May to February. So a bit of a dovish tilt from the banks. Whether that means they are going to cut in February, it puts the potential balance of risk to another hold. The Australian economy is holding up broadly. We're not seeing any sort of European style weakness over there. Their jobs market's still pretty strong. That sort of thing. There's no real red flags over in Australia. So might keep them, probably will keep them on the more neutral side of things. But the market's all getting febbed up, so that puts the balance of risks to disappointment if they do stay on hold. Kay, what do you think about the RBA or any other stuff? Are they going to be pushed into a cut in Feb?
I think they should actually, Ryan, just to make sure that they keep their economy a bit zooming, because. But the interesting thing is for them, as compared to Fed and ECB, for instance, is they will have a nearly full month of Trumponomics in the bag, and they will be able to judge a little bit more. So they could be somewhere a bit dependent on those events as well, than rather only on inflation and local data. But in my opinion, they should now, because you're never safe from an accident with Trump, right? And it's always better to just go and keep a little bit of support in there, not needing to really keep the rates above 4% where they are now, but just closer to that zone. So. In my opinion, they should. Inflation is coming their way, so there's there's kind of a good reason for them to cut in February, in my opinion.
Yeah, I'm in two minds. I know we know from fact that they tend to be a bit more hawkish, or let's say a bit more behind the curve than others. And has inflation done enough? I don't know. I wouldn't be surprised if they stayed on hold, and that goes against my trading position. So you know me, a lot to be objective about these things. But yeah, I don't know. I don't know if it's enough. I think if they got another print and it went the same way, that would be the icing on the cake. But who knows what these clowns?
Is definitely a hawker.
Yeah. Who knows what these clowns are going to do? As I say, what we do know is they'll be behind the curve, whatever way they do it. So yeah, if they go in Fed, they'll be happy if they indicate it's a bit of a cut phase that they're going to enter into. Then my shorts should do okay on that. We'll look at prices anyway in a moment. Riksbank, they cut their rate by 25 pips as expected. They're now at 2.25%. Probably the main standout from the statement that there was no forward guidance on future cuts. They've moved to be decided meeting by meeting based on the data, blah, 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 same as all the rest of it. In December, they indicated that they would likely cut again early in 2025. Now, they've done that cut. And as I say, there's no future promises on any further cuts explicitly as that. So maybe they're on a pause, maybe they're not. We'll have to wait and see. Traders, and this is not good news because this is my thinking. Again, more people watching the flow show, it seems, because apparently traders are now betting that the ECB will need to deepen and accelerate rate cuts. A lot of them citing the poor politics in Europe at the moment, particularly France and Germany, as well as economies, and also the possibility of tariffs. So that's a plan that was in my field of vision coming into this year. Now it seems, as I say, everyone else is jumping on the bandwagon with that as well. To prove that point, German consumer confidence disimproved, shall we say. It went to minus 22.4 from minus 21.4, so worse there. And it's also shown up the canyon between North and South Europe, because Italy's consumer confidence jumped to 98.2 from 96.3. Europe. People are looking for green shoots here. We're seeing this north-south divide again, but Germany's still in the mire.
Which is quite funny, because usually it's the south which is suffering a bit more when there is uncertainty or downturns. But now Spain is actually also printing much better numbers than anyone else in the Eurozone. Unfortunately, Spain, Italy, Italy, we know those numbers are a bit jumpy because they can go from sunshine to rain pretty fast in their data. But Spain is holding up very well. As I said, unfortunately, Spain can't hold up the whole Eurozone on its own, right? We've got that political mess in Germany, and now this morning as well, it seems that the French budget talks are on the verge of collapsing again. There's no two people in France who can agree with each other. It is really a bit of a mess over there, and it is weighing on economies for sure. If you displease some of the bigger parties, they are very fast in letting their followers start to get onto the streets and what else not, and it's really not a nice picture in what we should be calling the core of Europe, which is now the engines are have drowned, in my opinion. So yeah, Europe is not doing well. You know what? It's going to take something to reverse that, because it doesn't seem like, because we what is it, end of February we have those German elections.
Yeah, I think so. Yeah,
France is still in a mess, so that gives you another full month, which is going to probably show up and then a full month of uncertainty, and then you will need to see other data coming March, but those data will come out in April. I mean, for me, the picture in Europe is still very bad right now, and then you add the uncertainty of Trump in there. Imagine that he goes a bit hard, and now he sees that Europe is weak. He could go and get out wielding with some tariffs if they don't act nicely on Russian sanctions and what else not. Yeah, there could be a period of really more trouble for Europe. Well, I don't see the end right now. Let's put it that way. I was thinking that, okay, 2025, if they get their act together, it may mean that we see a little bit of a European revival, but we will have to wait for it to really um, see it happen, right? We need to
yeah,
see something happen there.
yeah, exactly, definitely. And maybe easing of the Ukraine war will be one catalyst. I'm not sure that sparks a growth boom in anyone, but at least it takes some neighbourly geopolitical pressure off everybody, and they won't have to keep sending tons of money and arms to. Because that's probably the only thing that's keeping Germany afloat, isn't it? Rheinmetall and the likes sending armaments to Ukraine. If it wasn't for that, they'd be in probably even worse growth
Yeah.
pickle than they are now.
Well, the good thing is it's raining again, so maybe the water levels in the Rhine are creeping up a bit, but that's a very that's a very fragile thing to hold on to say that the Eurozone is saved.
Yeah, that's true. That's true. Right, coming on to some of the US data we got yesterday. Durable goods came in a little bit on the soggy side. Headline number down 2.2%. So that was a big old negative there. But there is some big swings in some of the components underneath. Consumer related goods were holding up okay. I had a look at the report. The main drag on that number was from transport, which fell a whopping 7.9%. These numbers, there are some really volatile numbers within this: defence, aircraft, that sort of thing. But it was transport that did a lot of the damage to that number. So bad number, but not horrendous when you look at the components. As you can see, there was still a gain in those core durable goods there, even if it was a little bit of a miss. We had some house price data out as well. The FHFA yearly number coming down 3 pips to 4.2%. On the other side, we saw the Case-Shiller 20 city number year on year going up to 4.3%. The national number went up to 3.75% from 3.59%, 3.6%, if I'm not mistaken. So a little bit of a gain there. Overall, what we've seen from the housing market thus far is no real worries, nothing for the Fed to get concerned about. Prices holding up pretty well, staying steady. They have eased off a touch on the annual numbers, but nothing that wants any big scrutiny from the Fed. What might get some scrutiny from the Fed was what happened in the Conference Board consumer confidence data. We saw a bit of a pullback in the headline number. Though there was a bit of a wild revision. We saw consumer confidence coming in at 104.1 versus 105.7 expected. The prior was 105.9, which got revised up to that 109.5. So pretty big revision up, which makes the drop look even bigger, but it makes last month better. So it swings and roundabouts. But the important factor from that was 1 year CPI expectations rose to 5.3% from 5%. As I've been pointing out from the Michigan numbers, we saw a big jump there in the inflation expectations, both for the 1 year and the 5 to 10 year number, up to 3.3%. We got a little pullback on Friday to 3.2%. So this is now 2 surveys showing inflation expectations at the consumer level rising quite significantly. And as I'm often fond of pointing out, inflation expectations make up a big part of central bank thinking, because if people think prices are going to go up, they can do their buying now, and you get a little bit of a growth spurt that then dies off later. Not to mention the inflationary impact of stuff going up as well. So that might be something that the Fed touch on or Powell touches on tonight, although some Fed members don't see the expectations as being too harmful, but the data is suggesting otherwise. What do you make of the US numbers, Kay, that we've got at the moment? Still showing, ticking along nicely. No worries for the Fed on that side of things.
Yeah. I think if we look ahead to the FOMC, there's absolutely nothing in the data that should move them right now. It's just without even talking about how they compare to the rest. It's nothing in the data is telling me that they should do anything at all. No, so just keep the same line, I'd say.
Yeah. Over to Mr. Trump. We'll have to start doing a whole new section on what's Trump done now.
A whole new show.
Yeah, a whole new show, the Trump show.
Dear.
Yeah, we'll be here all day. Anyway, his latest lines, he's going to pursue the complete denuclearization of North Korea. And now the big news is he has basically offered, or sources say he's going to offer, all federal workers who want to take voluntary redundancy by the 6th of February, he will continue to pay them up until September. He's targeting around 5 to 10% of government workforce. That's around 3 million people who work for the government. So 5 to 10% is effectively an NFP print. That's 150 to 300,000 people who, if they take up his offer, will be coming out of federal government jobs. Now, don't ask me how it all works over there. What happens if you get redundancy in terms of jobless claims and things like that? But if we just take it at the worst case outcome, as we say, that's potentially 300,000 people dropping out the jobs market or the employment market. So it's a known unknown, but don't be surprised if we see that impacting in the NFP. But I don't know when. I don't know if it will happen when they effectively stop getting paid in September, whether it counts up from the 6th of February. Obviously too soon to hit the current NFP report, but we might see that early March. But it's a potential ticking time bomb from the NFPs, but it will be a known thing. So it won't be a big shock if we suddenly see down 200k non-farm payrolls print or something like that. We'll know likely what it is. Do you see anything significant from that, Kay? I mean, is this Mr. Musk asserting his Doge?
For the data, as you say, it will be telegraphed. But I think, yeah, it's hard to really say too much about it right now, because we will have to see what other measures they start to put in place. But if you combine it with those famous non-documented migrants or immigrants being sent back over borders, it may all of us may all of a sudden add up to a huge pile of workers getting out of the market. Although some of the migrants have not been taken into account either. But anyway, I mean, we are. We could be in for a bit of a yo-yo and a shocker on the employment market in 2025, and I think this is one of also of the risks that there are, because if you lose a certain number of workers, it could actually be taken as a positive, because less costs in the administration and all these things. But there's always inflection points in whatever happens. What may be seen as something relatively positive from the financial side is probably going to be a drag on everything on other stuff like consumption and things, once they are effectively out of the market. And yeah, I think we have to be very careful about inflection points this year. But as you say, it's going to be very tough to judge when exactly all these things are going to come together, or how much will they be spread out.
Yeah, exactly. So it's hard to quantify,
Yeah.
but it's possible that it's going to be coming along, and yeah, we'll have to judge the ramifications as we see them, I think. Right, let's go talk about AI, shall we? Because everyone's jumping on the bandwagon, and I'm sure China's just trolling the US at this point, because apparently Alibaba has released an AI model that it says surpasses the DeepSeek model. Alibaba is the cheap Chinese knockoff. Well, they do everything over there. Like, you can buy a tractor if you want from Alibaba, and some of the other bits and bobs crap over there. So they're all getting on the bandwagon now. I don't know if, as I say, this is trolling the US and the likes of Nvidia, saying that they can do all the stuff you can do cheaper, faster, better than everyone else. Unsurprisingly, the US has stepped up to ban the use of DeepSeek over security concerns. The US Navy being the first to say that no one's going to be allowed to use that within their walls. So, yeah, no shock that DeepSeek isn't going to get much shrift over in the US, or potentially anywhere else for that matter. Right, well, what have we got? We've got two central banks today. We've got the BOC and the Fed, so we'll kick off there. I've not really got much time to put any thoughts together for the Bank of Canada. We are. What do we do? Are we even expecting a cut today? I think we're expecting 25 pips down to 3%. I think the Bank of Canada, like the Riksbank, like some of the other central banks, their rates are now getting down into potentially neutral territory. So the risk going forward is whether they start to indicate that they've done enough for now, they're going to go into a pause, or they've hit their level, their neutral level on rates, and what they're going to do afterwards. So the lower the BOC cuts rates, the closer we're getting to potential neutral. They have been pretty fast with their rate cutting. It struck me, as I mentioned before, that they haven't given themselves much chance to see the effect of their rate cuts coming. So I think for the Bank of Canada, there is a risk that maybe they start to indicate a slowdown, or else they don't and they want to keep going. We'll have to wait and see. What are your thoughts on the BOC first, Kay?
Well, the surprise today would be that they don't cut, because of what may come. Because we've spoken about it. We have this big deadline coming up on the 1st of February. Is Trump going to slap tariffs or not? So there may be a case of them not cutting today because they want to keep ammunition for if something goes wrong next week. Yeah, the normal let's say thing would be to bring it down to 3%, and then yeah, just go as the Swedish Riksbank said, just go data dependent. I think today McLem may have just a little bit more of a fight back by Rogers, because I guess that she may want to be one that waits today. But the surprise would be that they don't cut. But will it make a big difference for the Canadian dollar, barring an algo blip? Let's say, for instance, if they don't cut, your dollar CAD could all of a sudden be trading 143.5 or so. But I think with the outlook of what may be coming on the 1st of February, I guess we are going to find deep buyers there, just for the sake of yeah, trading, front running potential tariffs.
Yeah, if I don't know, I might be tempted by a dip buy if they go on hold. If we get some of these levels down here, maybe a little runner to take into the Fed, because I don't see the Fed being dovish on that sense. So if they do go on hold, if it is a bit of surprise, I mean, you might get better than 142.60s on the back of that. With the CAD can be a bit of a wild horse when it wants to be, but yeah, I'll potentially consider a dip buy, depending on the outcome.
Yeah, but be careful what you do. Be careful what
Yeah,
you do then, for the end of the week, because on Monday it's gap open guaranteed.
yeah, exactly. Well, yeah, I
Yeah,
don't know. We know it's coming, don't we? That's my only thing. Everyone knows tariffs are coming. I think the
yeah. But
potential
I mean,
gap.
if imagine that he doesn't put the 25% up
Oh
straight
right,
away.
yeah,
I mean,
and
then you got your dollar CAD is trading 142 or 141, right?
yeah, but then on the flip side,
And if he does, it's
we could get a
46.
headline that they're going to secure a deal. Everyone's rushed to the table to secure a deal to avoid those tariffs. So yeah, I definitely won't be running into the weekend. I'll give you that, unless I'm like 300 pips on side, something like that. But
Yeah.
if I do anything, but no, maybe just a quick 1-2 over the Fed, perhaps. But we'll see. So moving on to the Fed, I think Powell's task today is stopping the market from getting too hawkish. Okay, we are expecting them to pause, keep rates on hold today. The risk for Powell is how the market deems this pause, or how they sell this pause. Is it just a skip, or are they going to be on hold for several meetings, 2-3 meetings? And I think, as I say, that's the task. We already know, been speaking about it, the market has slowly got more hawkish on expectations about the pause. And this meeting is going to be important. As I say, these first meetings of the new year can be very important, because it's going to, at the very least, set market expectations probably for the first half of the year at the least. Okay, so it doesn't matter what happened in December. Everyone wants to know what they're going to do this year. And it's going to be pretty important. I think Powell's got a bit of a job walking that fine line between not being too dismissive of inflation and sounding too dovish, but also not being too hawkish. So I expect the sound bites to include both sides of the hawk dove case, whilst trying to stay in the middle. But the risk is that he's a bit more dovish than the market's expecting, or less hawkish than the market's expecting. If he says it's a skip and that everything's still on the table for every meeting moving forward, that might give the dollar a little bit of a knock. But yeah, he's become a master at walking that fine line. Kay, are you expecting anything different?
Yeah, absolutely. And I know my base case is that he is going to walk the fine line, because he cannot do any otherwise, based on data and what's potentially to come. What I would say, that regardless whatever he does or says today, Trump will shoot him down afterwards, right? That is something that I think our audience should be aware of, regardless whatever he does, unless he cuts, of course. Then he may get
pat on the head.
a bit of an applause, but he shouldn't. But regardless, whatever he says, he's probably going to be shot down. And I think we should be a bit careful with picking a side based on what Trump is going to say today, because he's he's for sure not a fan of Powell. So he's probably going to nail him later on. But I know I think Powell stays in stays in the middle. Not enough data to cut. But as you say, he may just leave the door open, because they must have ran their models as well, for different scenarios, with more or less no tariffs, and he may somewhere have like ready-made answers, because the questions will come, right? In the Q&A.
Yeah.
Those questions will be coming, and he may have some model-based ready answers to give to the press. So there may be a little bit of a hint, I would say, at the potential risks of slapping higher tariffs. And but in which case he will actually go a little bit the way of the way Trump wants to see it. Because if you say that there are risks to your economy, okay, and we have been talking about risk to inflation, about tariffs and things like that, but it's much more complicated than that, in my opinion, because
Yeah.
you may have risk to inflation, whatever side, but then you have a big risk to growth, global
Yeah.
growth. I mean, a lot of tariffs can put a very, very big cap on not only non-US growth, but even the US growth as well on the back of it. So yeah, there could be some stuff in there that says, well, let's be careful here, because we are not only looking at inflation, we're also looking at growth, and that could be the dovish slant, the dovish side of what he says today. He's keeping the door open to what comes. Is probably going to be, as you say, very, very important, but it's the way he brings it over. If it's, oh, we are aware of the risk that tariffs can put on inflation, is one thing, but we also are very aware of the risks to growth, and that would be, to me, the more dovish side of things,
Yeah, and we might even mention the government thing, and
Oh, yeah,
the
now
jobs.
that it's out in the open, yeah, you're right.
Yeah, that jobs. They're there to protect the jobs market. That's their mandate: full employment and stable prices. That's the mandate. I think whatever happens, these meetings, there's lots of different outcomes. We've got the Trump thing in the middle of it as well, where he could say anything and move the market, whatever. You have to come back down to the fundamentals, and the fundamentals are that the Fed still want rates down. That's at the back of their thinking all times. Even if they have to hike again, they still want rates down. The US economy is still doing okay. It's still, even if you take out the tariff risk, it's inflationary on its own, because the economy is still doing so well. People are getting paid, people are getting decent wages, jobs are still plentiful, the economy is ticking along. You get natural inflation from that. It's not blooming to 10% inflation like we've seen in shocks, but it just means no one's cutting prices anywhere, because they're not trying to scrabble around to get business. There's no need to cut prices, and there's opportunities if you're making good money and people are paying it. You edge your prices up a bit and try and make a bit more margin. So that's part of the reason why the Fed are going a bit more to the hawkish side, is because they've got that natural inflation pressure on top. If Trump brings additional pressure, whatever, that's something to deal with later. But the US is in a stable inflationary environment at the moment. So you've got to take that into account, whatever Powell does or says as well. One thing I did miss out on. Yeah, go on, mate.
Take Trump out of the equation. This would be the easiest monetary policy meeting they would have had in years. But now you have that thing, and whatever he brings to the table, as you say about those jobs and stuff. It's it's going to be a mess, I think, from now on. A real mess.
Yeah, exactly. And as Mike's just said, Canada and Mexico just need to agree to reopen the USMCA negotiations earlier than scheduled, well, before Saturday, and that might ease things. Well, we've had Canada's Freeland. She was the economic minister up until December. She quit that job in Trudeau's government to actually run for leader. Now she says that Trump is targeting allies to send a signal to China. And that Canada can be a partner to the US in rebalancing trade. Now, one of her sales pitches for becoming new leader is that she will call on day one, if she becomes leader, on day one, call for a summit of nations targeted by Trump if she becomes leader. The thing with Canada, Kate, Trudeau's still in charge, but we know we're heading to a new leader, government, whatever. Who can make the decisions about what happens ahead of Saturday? Is there anyone there who's got the ability to do that?
I don't know to what extent he's already listening or taking potential people that will take over as opinion into account. But it's I think there's probably an additional risk to Canadian dollar if they don't go and if they don't go straight away to the table. We know that Trudeau and Trump don't like each other, especially Trump doesn't like Trudeau at all. So if Trudeau says something wrong, that may get the markets even more negative, Canadian dollar in the short term at least. Yeah, I mean it's a good question, Ryan. I really don't know who is well, Trudeau should be making decisions right now, but does he still have the backing of enough people to support whatever decision he will make?
Yeah, exactly. We shall see. If you have to
Mike
pick,
says but Canada has had delegations in Washington, I think, since Trump's election and even before. I think they're constantly over there, Mike.
yeah, I think if on the balance of risks, you might think that there's more chance of Mexico getting a deal done before the weekend than maybe Canada. So, you know, it's not going to be that both currencies are going to go the same way. We could have the Mex benefiting if they get a deal done, and Canada dollar going the other way. Right. Anyway, enough waffle about that. Let's get into looking at some prices. Firstly, I'm going to go back to Main King, who I saw your question yesterday, mate. Apologies for not getting round to it. Talking about folding trades. What would be an example of taking an FX position that is fine to run for ages in the current circumstances? I think you're talking about our constant warnings about headline markets, Trump markets, where, you know, moves can be reversed or moves can be accelerated by a headline, a squawk, a tweet, or whatever, and just being cautious in taking profit. But that's not to conflate that with trying to run a trade. Okay, my philosophy: if you're in a winning trade, you should stay in that winning trade as long as possible. And there's nothing wrong with keeping that philosophy for these types of markets. So any trade you can run for ages, Main King. If you're in profit, then run it. But you have to take the conditions we're in at the moment. I.e., if you see some profit, it might be wiser to take some profit quicker, move your stops quicker, get to break even quicker. Okay, just because of that increased volatility risk that you could get tipped out very, very quickly. Take the Fed as an example. Kay said it, and I've said it before. If you're watching Powell on one screen, you got to have Truth Social open on the other, because Trump could pop up at any time, even during Powell's presser, and post something that's going to move the market. So Powell might go, yeah, we're on pause until the rest of the year. The dollar's shooting high, and Powell says Trump comes out with something. completely against that. He's going to weaken the dollar. The Treasury is going to go after this, that, and the other, and we see a complete reversal. Okay, so you can run any trade you want for as long as you want within your parameters and strategy if it's going your way, but just be mindful that there's greater volatility. So being a bit more nimble in your profit taking and stop moving and that sort of thing is more warranted at the moment. I don't know if you've got anything you want to add or take away from that, Kay?
No, it's just that there's so many moving parts in this market right now that it's quite tough to have a long-term view on FX. That if I understand the question right, to keep for ages, meaning that you take a position now and you say like, oh, I want to run that into 2025. It is very hard because and whatever currency you look at, it's already hard to see what's around the corner. Even if you take away the dollar, which we can't, of course, because as I've been pointing out in my 2025 preview that we posted on the ForexAnalytix webpage, Trump is still having the traffic lights remote control, right? So he's going to direct a lot of stuff, and I would say when we will know exactly whether it is real tariffs or it is the threat of, and it's rather going to be a Besen style, I think then we may start to look at putting on perhaps some longer stuff. But the data for now is the data for now are even like employment data, right? They have been defying all laws of gravity in 2024. The last one in 2024 was even a better number, but I think those in 2025 again are going to be a big driver. So you may say that even if it doesn't go like really too hard on tariffs, okay, that may be a negative also for the dollar. But then if your economy holds up in the US, then why would you be short dollars for longer? It's to me, it's still too difficult. And yes, Ali, but we were talking about pure effects, I think here. I mean, gold and silver and some of those industrial things as well is perhaps a different view, because gold has been a different view, okay? Because the gold has been a trade which is a hedge against all the bad things in the world. And regardless where interest rates are moving, regardless where the rest of FX is moving, I'm viewing gold as a different kind of instrument. And yes, I've been long for a very, very long time. There's, as Brand says, also physical stuff in there, but also hedges. I mean, imagine that you're in China, and I'm not talking about the PBOC, but imagine that you're in China and you know that Trump is going to be elected. You know that Europe is also not looking at you with the best of eyes because you are supporting Putin and everything. It's a bit logic that there has always been demand for gold, but that is just a combination of a lot of factors. So no, I was talking about FX. My pure FX positions, currency positions are much more shorter term than that I had before.
Yeah, exactly. And my last add to that is, think of trade at the moment like fishing. When you go fishing, you want to hit the big record-breaking fish, the big stuff. But there's nothing wrong with landing 100 tiddlers, because it can outweigh the big ones. So, if you have to do a lot of little trades, taking lots of little profits to get through this type of market, then that's what you have to do. You have to adjust with the conditions. Right, let's move on. Kay, I'll leave Aussie dollar to you. I'm going to look at my Aussie Kiwi because that had a move over the Aussie data. We got a move down to 110. It's bounced. We're now knocking around this old 38.2 fib. Can't get under this 15-20 level, whatever you want to call it. There's a few little bits and bobs around here, but at the moment we're holding below it. So if the RBA get more data like this and the market starts pricing in more cuts, then we're probably heading a bit lower. Whether we're going to get down to these lows again is another question. Same for the Aussie dollar, which I'll let Kay have a look at. Euro sterling quickly, because of what's going on with Reeves and Starmer, as I say, on that growth offensive. Their tone has changed. They've been very, very negative about the UK finances, what the Conservatives have done and everything. And I think they've finally woken up to the fact that if you talk the country down long enough, then you start upsetting investors. And I think some of this pullback that we've seen, this bid in the pound, has been on that change of tone. Not seen any big moves after Reeves has finished her waffle, so the market maybe had already priced in the change in tone already, and we've got nothing big for investors to jump on from her speech today, not or stuff that we didn't know days before. Anyway, right, Kate, let me bang it over to you for a couple of times ticking on.
Yeah, I'm going to go rather quickly as well.
Yeah, I can't find my button. There we go.
Right, question about the Aussie. I don't like it. I said already in our room as well a number of times. I don't really like what happened on the Aussie. Before we got into inauguration, I bought actually a 63 and a quarter call, because I thought if we get through 63 and a quarter on the Aussie, it's likely gonna run. And look what happened. We capped right there. And we're starting to come off again. I really don't like the way this is trading right now. So we failed at 3 and a quarter. We're back below 62.80, 62.70, which is an additional reason why I don't really like it. And we are very close to support here, 62.20. We're already trading well around 62.30, but it still doesn't show me too much strength. Now, I'm straight away going to go to the other question about I'm about these month-end flows. Okay, today we are trading value date month-end, and as you know, there's two things that we need to look at in month-end. On the value date of month-end, which we are trading right now, we might see a bit of U.S. corporate dollar shopping. It's not a guarantee. There's been months in the past 6 to 9 months where we didn't see anything happen at all. And based on equity moves, we should see small reversals of that into the end of the week. But if you look at what the European bourses have been doing since the beginning of the year, I would not be speculating on any euro moves. And of course, we have the Fed, and we have the 1st of February potential, because we always talk about Canada and Mexico, but Trump could be in super form and start to talk about any other country in the world as well. So I'm not sure that I'm going to trade too much of month-end stuff this time. But anyway, Aussie dollar to me, bit at risk here. Okay. So we could be in for a bit of a move down. I would say somewhere around 61.75, if the market thinks that the Fed, and if the Fed is holding the line relatively firm, we could see a bit here. I really think that we need to get back first of all above 62.70, 80, and then the real thing, and we see same thing on the Kiwi. Yeah? The real thing for me is the real level is 63 and a quarter, even on the in the more medium term as well. That really has to go before we start looking at a more medium term recovery of the Aussie. For now, it's really, you can see as well a bit of a bear flag. It's really not looking good still for me. I will really wait to form better opinion, especially if you're looking at buying it, but I trust you don't. Um, I'm just going to run through the euro dollar since we've broken this, which could also be seen as a bit of a bear flag again, around the 104 104.40.50. It came in offered. I think today. And also looking at how it's going in Germany, France, etc., there is a case for this to trade a little lower going into the Fed this morning, maybe 103.70, maybe 103.5. I do think that any bounce up to 104.5 before the Fed would run into a bit of resistance there. That's the euro dollar. I'm still not a fan of euro all in all. Okay. Um, Sterling is looking dangerous here, but it's trying to hold. It is trying to hold up. So 124 figure 15 is your little zone here, and I'm just going to stop on this. I think 124 figure 15, wherever you end up after the Fed maybe tonight, is going to be important enough for the cable in the short term. Okay, and with that, back over to you, Ryan.
Thank you very much, mate. And that's it. Yeah, a bit of a long one today, but we try and squeeze as much in as possible. Don't forget to come and join us on Face over with the US lot later on. We'll try and make sure they squeeze in the BOC as well, because you know what them lot are like. They'll just be talking about the Fed all day. So have a good day, everybody. Trade safe later on, across both central banks. Watch for that True Social platform as well, and we'll see what's happened tomorrow. Have a good one.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.